Hey traders, Raghee here. Welcome to Charts and Coffee. Great to see everyone. Happy Monday. Hope everyone's doing great. Hope you had a good weekend. Pretty good weekend of football. I guess if you're a Philly fan or a KC fan, but overall, hope everyone's doing great. And we're ready to start what will be a very interesting week. If you joined us for let's go take a look at the economic calendar. If you join us for Sunday's Raghee report, you know that we are looking very, very, very much at two specific days this week. The most important, despite the earnings that we have this week, the most important is definitely going to be not even the actual decision on rates, which is expected to be a 1/4 point hike from the Federal Reserve, but more so what's going to be interesting is whether or not they are going to discuss, meaning they, Powell, whether or not Powell is really going to clarify the timeline between March, say May, and are we going to hit that peak target rate, that terminal rate, and then what after March or May we can start to anticipate from them as we potentially prepare for a November or December rate cut. Yes, possibly this year, possibly. But the peak rate seems to be coming March or May, maybe June. So ultimately, what we can't presume is that the target rate will hit 4 3/4 to 5%, that it may not get an extra 1/4 point bump to 5 to 5 1/4. Then we get into Thursday. We have an ECB event, so that's going to be huge for treasuries. It's going to be significant for indices. It's going to be significant for the U.S. dollar. So let's not forget that ECB event. But I think a lot of us know that as we take a look at the economic calendar, we have Apple, we have we have Amazon, we have Google, we have big earnings coming up on Thursday. Most definitely going to affect all three indices, most definitely going to affect that consumer discretionary. It's going to affect the XLK ETF. So obviously, while all eyes might be on earnings, let's not forget we have an ECB, European Central Bank event. We have an FOMC event as well. And monetary policy, if I'm weighing the longer term, not the immediate impact and not the volatility, the immediate volatility, right? If I look at the longer term impact, the central bank events are going to be far more important than whatever crazy movement we see when we get the earnings from those companies. All right, gang. So that's pretty much what we're going to be expecting this week in terms of hot zones. And so let's move on then to our questions as always. And if you haven't already seen it, and if you haven't already had a chance to pencil it in on your planner, heads up, we've got our, right in here, we've got our webinar coming up basically in about 2 weeks, gang, 2 weeks from this Wednesday. So really stoked to talk to you all about what I'm doing in the market. What adjustments have I made from 2022? From 2020 to 2021, we made adjustments. From 2021 to 2022, we made adjustments. And mainly because of monetary policy messaging and action. So where are we now in the scope of a fairly mature tightening cycle, and which timeframes, which tactics are making the most sense right now? So we'll talk a lot about that in about 2 weeks. We have a long year ahead of us, and I would love to create a really good foundation with us all. So we're looking at all the factors of the market, right? Time, price, volume, volatility, with particular emphasis on structure. Super stoked for that. So let's go ahead and get into our questions. All right, first up, hey there, Stacy. How about hitting the like button? No, I appreciate that. I appreciate that. Um, I'll tell you what. Yes, the show that we do every morning. We're coming up on 3 years, and I'm here because y'all are here. I'm here because y'all have great questions. It allows us to prepare. So thank you for 3 great years of almost 3 great years of putting this show on here, and for your questions and for your participation. Otherwise, I'm just talking to my dog, who frankly isn't all that interested, who might be actually tangled up in the drapes right now. Okay. All right. Hey there, Joe. When I'm getting out of a trade that I am up on and want to trail a stop, how do I determine how much room to give it? Joe, it depends on what type of trade, right? Intraday is going to have a different set of levels than, say, end of day. We tighten the stop oftentimes. One of the most mechanical, easiest ways to do it, not that that's where you have to stay, but it's a really easy way to do it, is if you're hitting a T1, I like to move to a break even at that point. That's the basics of my market money math. That's the basics of the holy grail of position sizing and trade management and risk management. But upon hitting T2, I'll usually trail or tighten to T1, to the first target. And that's the way that I like to consider the way in which I can sort of ratchet with the action. And I think the emphasis is always on, how do I protect the downside? Always. How do I protect the downside? And then considering that oftentimes the downside is going to be comprised mostly of unrealized profit upon hitting T1. That gives us a lot more latitude to be a lot more ambitious about a T2. And that's probably one of the bigger mistakes traders make. They get very, very lax about where that first target is going to be. They're willing to let the market move way too much in their favor before they start making risk management decisions. That's a big, I think, error that I probably made early in my career, fixed it, and that's how I teach it now. So how much room to give it probably has a lot to do with unrealized profit, risk to the account, which target have we hit, but those are pretty easy mechanical things to do. All right. Okay. Next up, thank you, Joe, for the question. Next up is Robert. Are there sectors that I look to get into during weeks like this, or would I stay out of the market or day trade until the news has settled? So, Robert, I mean, there's not particular sectors on a week like this that I'm interested in, although I know the volatility, the impact is going to land an XLY, an XLK, XLC, QQQ, and the NASDAQ futures, S&P future. I mean, it's going to hit everywhere. These are not stocks that necessarily have these boundaries between indices and sectors. I mean, they're going to be wide reaching in terms of that temporary impact. So I'll look at where those stocks are most heavily weighted. That's a great place to start. As far as staying out, there's two ways to look at that. Robert, I can either stay nimble, to your point, and trade into those events and stop. So I'm not in significant exposure once those volatility events hit, those hot zones. So I could trade and just stay nimble and trade around those events. Or I can trade a time frame long enough where I can presumably handle the volatility of those events. In other words, maybe a 1 hour, right? Maybe a 1 hour is going to give me enough, well, in this case, travel, right? If you think about a suspension, the suspension on a track car, very different than the suspension on, say, an off-road vehicle. We're going off-road. We're going to need to account for boulders and potholes and whatever else that we're going to have to go over, which are going to have varying degrees of impact. So I look at this as going off-road. This is not going to be, on the track, smooth tarmac. We're going to need some travel in that suspension. And one of the ways to do that would be to modify the time frame that we're looking at. So I hope that makes sense. All right. For those of you mentioning that the stream didn't start, gang, I use some software that should correspond with all my different channels. And once we go live, sadly, I don't have granular control of when that starts. So it seems to have been a little bit of a glitch today. Don't know why. I apologize, but I think that's maybe the first time we've ever had that weirdness. But thanks for your patience. All right. Good morning. Hey there, Frank. Sometimes I actually have to leave the house and work my construction business. Sure, I get it. We were talking about that during the Raghee report yesterday. When that happens, it's hard for me to take a trade mentally when not seeing the full charts. Any suggestions? Slow things down. Absolutely, Frank. Slow things down. Don't day trade unless you're able to day trade for those 60 to 90 minutes that I like to prioritize. And then you could be flat, or you can be in a situation where you have a stop order and maybe a target, and a one cancels the other, linked to them. So you can walk away knowing your trading platform is handling that. That's one way to do it. Another way to do it would be lengthen the time frame. So that's what I mean by slow it down. Lengthen the time frame. Look at a 1 hour. Look at a daily. I think a daily would be a really great place to start. Look at those longer term time frames where you don't have to make as many decisions intraday. On a daily, you can place an alert, and when price reaches that level, it'll buzz on your phone, it'll, whatnot. And then that way, okay, let me bring up my platform on my phone. And I love to do this. So I'll bring my platform up on my phone, and I'll, put in the symbol. Oftentimes when I'm using TradingView, my alert on my phone will pop up with the order that I want to put in, buy this particular call. This is the strike. This is the expiration. So I don't even have to remember what it is that I wanted to do. It's all built into this TradingView platform alert. And then once that opens up, I can go to Thinkorswim or, whatever anyone's using, as long as there is a mobile app. And that's one thing I will say that I look at when I'm going to trade with a broker. If I'm going to be looking at 1 hour and daily timeframes with that broker, it better be a robust, steady, solid app where I know that I've got access to my account and I can put in a basic order like buying a call, selling, liquidating, taking a profit, exiting at a stop, buying a put, whatever it is, because that's all my trading basically is on the option side. Very, very, very straightforward. We're not putting in multi-leg things. We are straight up buying calls, buying puts, and managing those positions, which again makes the process that I teach in the mastery very much a process that anyone can do, with a phone when they have a job, right? I mean, that's one of the things we hear a lot right now. Folks are saying, Rog, in 2020 and even 2021, I was able to trade from home, but I can't now. And unfortunately, back then I focused on a process that required me to be at home. What do I do now? And that's really a lot of what I'm going to address at the webinar, which is I'm getting a lot of those types of comments and questions, and it's frustrating, and I get it, right? It's really frustrating for a lot of traders thinking, I've learned how to trade, but now, another part of my life is taking precedence over my trading. How do I keep engaged with the market? And that's where I say automation of tools, not subjective analysis, and longer time frames are really going to make a huge difference. So I totally hear you on that one, Frank. And by the way, when you say you can't see charts, grab even a free, or even I think it's a $9, $10 a month TradingView account sign up. And gosh, I'll tell you what, if you use the kind of tools that I like to use, everything that I put on Toss, I think nearly everything is available on TradingView. And when I log into TradingView, I've got my wave, grab, propulsion, DPMR, HPMR, multi-trade. I don't know if you can see that. Look at that. You can see the DPMRs and everything, as well as my ring light. It's fantastic. So I have my charts available wherever I am that I have an internet. All right. Next up was XLC. Hey there, Mr. Walker, on the 1 hour. XLC I like a lot, Mr. Walker, but remember that depending upon the strike, the liquidity on XLC can be really tricky. Check out the open interest. I like it as a trend follow. I think it's a good looking chart, and we're breaking. Now take a look at the daily. This does matter, even though we're talking about the 1 hour. Notice how XLC is finally trying to gain some footing above the 200 propulsion. Gang, that's the equator. That's a significant line in the sand. That's a huge, it might be only a small line of dots, but being above that is now inching into the bullish hemisphere. That's going to make a big difference. Accompanying that is a gorgeous uptrend on the 1 hour. That would be a buy the dip. That would absolutely be a buy the dip. Hey there, Donald. I missed the Raghee report yesterday. Oh, no worries. So let me show you what you can do. Easy peasy, lemon squeezy. Head on over to the, oh, that's not what I wanted to do. Head on over to the Simpler Trading YouTube channel, probably the channel most of you are on right now, or the Raghee YouTube channel, the Raghee Horner YouTube channel. And if you go under live, you'll see not only the session we're having right now, but you'll see the Raghee report. I used the wrong, when I was programming this in, I used the wrong image in the background. That's my bad. So even though it says charts and coffee, take a look at the title and you'll see it there. In fact, I can probably share that with you all here in the chat. So if you missed the Raghee report yesterday, Raghee report replay. There we go. So Donald, thanks. I appreciate it. Thanks for the question. Okay, next up is, let's see, RTX. RTX, sure. RTX has been a really steady trend for some time. Most recently, though, throughout January, it's been getting choppy. And this is where, and this is something we've been doing quite a lot of in the mastery, which is using that 200 propulsion. The 200 propulsion, gang, is part of the top system. And what it does is it takes advantage of two moving averages, in this case, the 8 and the 200 crossing, as well as some other things. But the bottom line is this represents essentially a self-correcting 200 exponential moving average. And in a neutral environment that's oversold, that's the slow stow that I use in the mastery, also part of this top system. Take a look at that. Neutral, check. Oversold, check. 200, and then there's certain patterns that I look at, price patterns, and that's about as textbook as it can get. That's RTX, not a trend follow, but definitely a buy north of the equator, right? North of that all important 200. DC asks, XLB, sure. In a daily trend, how do I like NEM and the 200? Is there a better boat? So XLB looks really good. Now, I know my mastery folks, we've got that longer term weekly position built off the lows back in here. So that portfolio position, which is something that we do in the mastery, yeah, that's alive and well. So DC, I mentioned that because I've got skin in the game. I think that, of course, I'm going to be a little biased in terms of the bullish analysis because, well, I'm long, right? NEM, if you take a look, gorgeous uptrend. So right away, you can see that individual boat's looking like a relative outperformer compared to the tide, right? What else looks good? Well, I won't say. No, let me take that back. It's in conjunction with the tide. Freeport McMoran is probably my favorite, but then again, we just put that trade on in the mastery, and we had a nice, I don't know, 3x trade on that. So you better believe I want in on that again. But FCX, NEM, I'm with you. XLB itself, which can be a little iffy on the liquidity, but FCX and NEM have a more established uptrend. They've been moving higher for longer, I believe. NEM's just now retesting the 200, so that could be really interesting there. NEM around that 200, that would work. And here's that FCX I was talking about. FCX is going to, by and large, move with copper. So for those of you that are noticing, we seem to have a lot of risk appetite in not just the US markets, but global markets. Stronger crude, stronger copper are great evidence of that. We already have copper strengthening, and one way for non-futures traders to engage copper would be to play Freeport McMoran. So that's another way that I would look at XLB. Yeah, absolutely. All right. Okay, gang, just like that, we are out of time. Thank you, as always, for your time here. Oh, you know what? Got one little question I'm going to answer there. Andres, do I use tape reading on options for a trade? I do not. No, I do not. I don't. Not that there's anything wrong with tape reading, but I understand flow and I teach folks how to use flow and momentum, but we've automated all that into our process and into our indicators. So really, I don't have to. I used to a lot, probably in the mid to late 90s when level two and then later depth of market became something that retail traders could access. But I won't say it's a big part of my trading. Nothing wrong with it, but I believe the automation of my tools take care of that process. So thank you for the question. All right, gang. As always, thanks for being here for Charts and Coffee, and I'll see you tomorrow. Same time, same station.